Hi, I'm Jeff Bermet. I'm one of the co-managers of the Libero Cautious, Dynamic, and Solutions portfolios. January was a very good month for us, and I'll let Nick Davis, my colleague and co-manager, discuss what worked for performance. I want to step back and talk more generally about the investment environment this year and the changes that Donald Trump, now being inaugurated as president of the U.S., what we have seen them mean already and what they may mean for the balance of the year.
So I'm pleased to say it's been a very strong month for the portfolios, both dynamic and solutions, over this period with very strong returns, despite what we've seen in concerns of turmoil about Donald Trump's inauguration and the activities of his initial pronouncements.
I think the first thing that's worth thinking about, inflation is still rather contained, and we've seen both the European Central Bank and the Bank of England cut rates already this year by 25 basis points each. The Fed met in January as well, and they decided to keep rates on hold. All three central banks still seem very comfortable that inflation is contained and is likely to continue to stay low, possibly fall further, and will perhaps allow them to make further cuts. But the emphasis in the markets has changed for two reasons, away from central banks, and first to Donald Trump. And he, during his campaign, talked about putting tariffs on the exports of foreign goods into the U.S. in order to rebalance trade with the U.S. He threatened tariffs on Canada, Mexico, and China. And Canada and Mexico, they were significant tariffs of 25%. In China, it's only 10% so far. But very quickly, negotiations with Canada and Mexico halted the imposition of tariffs, delayed it for 30 days, and we'll just have to see how Trump is satisfied with the accommodations that those two countries offered. China's already under a reasonable amount of tariffs on their goods going to the U.S. And they're early in offering countermeasures, and there haven't been yet any public notifications of negotiations there. But the financial markets did not like this. When the tariffs were announced, the equity markets sold off, the dollar strengthened, and then when the deals were struck, everything reversed, and it happened all very quickly. And I think this new level of day-to-day volatility is just something we're going to have to live with. This is how Trump makes decisions. He's very public in his thinking. He announces policy changes over social media, which is very different from any other president we've ever seen. And this is just going to be how the markets are going to have to adjust to how he behaves. The second big shocking bit of news was the release of a Chinese artificial intelligence app called DeepSeek. And what was magical about this app was that the creators of it released a report that said they spent far, far, far less than OpenAI and Google and Microsoft are spending on their AI initiatives. We're talking 1/10, 1/20th, 1/50th of the spend that these big mega cap tech firms have made. This has thrown into question the validity and the usefulness of all that spending that they have made, particularly the spending they've made on buying the high quality graphical processing units that NVIDIA makes. And remember, NVIDIA was the largest valued equity in the world. And on the day that the DeepSeek news came out, it dropped about 20% in value. It lost nearly $600 billion of market cap in a single day. It has really raised the specter of perhaps quality AI can be produced at a lower cost. What we've seen so far in the first 5 weeks of this year is that if the earnings of these big mega cap tech companies do not meet expectations, their valuations are so rich that you can see big declines in their share prices. Fortunately, that has never been the key focus of our portfolios, and I think I'll let Nick talk about where we have made money and what those other driving forces have been.
The stock selections, as Jeff mentioned, we haven't been overly reliant on being invested in a number of the big tech names, and we've avoided some of the larger chip manufacturers where we had concerns over valuation levels and the prospect for any disappointment. So we have the exposure there, we have sufficient that's given us enough to participate in the rally, but not too much that's given us a real problem so far this year. For our exposure to cybersecurity, that has actually helped us. So it's still a tech exposure, but in a slightly different way. And again, one of the reasons we added this cybersecurity exposure into these portfolios was because of the lower valuations and the reduced volatility we saw from this sector regarding more traditional tech names. One of the key themes we've had in the portfolio is energy and mining, and this is again really on the back of the increased use of technology and AI, as Jeff mentioned. All of these things require either electricity to power them, or they require copper to actually transmit the electricity to various places. As Jeff again mentioned, it's been a very broad spread of where returns have come from. So I actually have a list of stocks to look through where we've had such high returns, and includes companies such as Thales, Qualcomm, JP Morgan, and a recent investment we made was in LVMH, which, given the economic outlook, we still think the expenditure on luxury goods and high quality drinks still has an area to grow from. Again, this is slightly a reflection on where we think we see a recovery in China and the activities we've seen there by the government to stimulate the economy. Again, this is an area where we've seen some really interesting moves, and Alibaba, where we made an investment again towards the end of last year, has been one of the key performers for us this year. European defence has been an area we've talked about frequently, and again, given the comments we've seen from Donald Trump, the impact towards expenditure and the impact of tariffs, how do we offset that? And we've already seen the negotiating tactics are, I'll impose a tariff on your area, and some sort of response from those leaders in those areas, both the Mexicans and the Canadians, has led to that temporary suspension. We've long suspected that defence spending has been a bugbear for Donald and his previous administration, again now, and how effectively Europe gets a free ticket on the NATO defence and doesn't spend enough into the pool of defence. Also concerns about will the US continue to back NATO at the same level it has done in the past. Again, with increased risk and concern of European countries regarding the aggression seen from Russia into Ukraine, this has been an area we've focused on, and this has really become much stronger this year in terms of performance. And again, as European countries look to re-equip and re-update their existing equipment. So consistent returns that we've seen from that, this has really picked up pace so far this year.